If you are watching this, you likely believe that markets are efficient. You believe that the price you see on your screen, the spot price of silver ticking across the bottom of CNBC, is a reflection of reality. You believe that if you buy a contract, you own the metal. If you believe that, you are about to lose everything. We are sitting at a moment in history that scholars will write about for the next century. It is Sunday afternoon. New York is closed. London is asleep. But in exactly 7 hours and 13 minutes, the Shanghai Gold Exchange will open its doors. And when it does, it will trigger the largest forced transfer of physical wealth in modern human history. This is not a prediction. This is a mathematical certainty. Right now, a silent war is being fought. It is not being fought with missiles or tanks, but with cargo planes and delivery warrants. While the Western world watches football reruns and worries about interest rate hikes, the Eastern world is engaging in a vacuuming operation of unprecedented scale. Here are the numbers that the algorithm is trying to hide from you. The price of silver on the COMEX in New York closed Friday at $76 per ounce. But the equivalent price in Shanghai, adjusted for currency impurity, is sitting at $94 per ounce. Do the math. That is an $18 spread. In the financial world, an $18 spread on a commodity like silver isn't just an inefficiency. It's a smoking gun. It is proof that the paper market in New York has broken away from the physical reality in Asia. It means the COMEX is pricing a promise of silver, while Shanghai is pricing the possession of silver. And tonight, the market is going to realize that promises are worthless when the vaults are empty. In this video, we are going to expose the mechanics of the great arbitrage. We are going to track the flight manifests of Boeing 777 freighters currently over the Pacific Ocean, carrying billions in bullion. We will deconstruct the legal clause known as force majeure that the banks will use to steal your wealth. And most importantly, we will show you why, by the time the sun rises over Wall Street tomorrow, the silver market as you know it may cease to exist. This is not financial advice. This is a crime scene investigation. To understand the gravity of this situation, you first need to understand a concept called arbitrage. In a perfectly functioning market, an ounce of silver should cost roughly the same in New York, London, and Shanghai. If silver costs $25 in New York and $26 in London, traders will buy it in New York and sell it in London until the prices equalize. This is called closing the spread. It usually happens in milliseconds, executed by high-frequency trading algorithms. But today, the spread isn't closing, it's widening. Let's look at the Shanghai premium. Why is silver trading $18 higher in China? The mainstream media will tell you it SOA, temporary dislocation, or a logistics bottleneck. They are lying. The premium exists because China is a physical-only market, while New York is a paper market. In Shanghai, when you buy silver on the exchange, you are expected to take delivery. The metal must exist in the vault before it can be sold. In New York, on the COMEX, for every 1 ounce of physical silver in the vault, there are roughly 25 to 100 ounces of paper silver traded. This works fine when nobody wants the metal. But what happens when a major player decides they want the physical bars? Let's walk through the trade happening right now. Imagine you are a bullion bank or a hedge fund. You see silver at $76 in New York. You see it at $94 in Shanghai. You buy 100,000 ounces on the COMEX for $7.6 million. You demand physical delivery, standing for delivery. You pay roughly $0.50 per ounce to fly it to China. You sell it on the Shanghai Gold Exchange for $9.4 million. Your gross profit is $1.8 million. It is risk-free, it is immediate. And because it is risk-free, every rational actor on the planet is trying to do it at the same time. This creates a vacuum effect. Every available 1,000-ounce bar in the New York vicinity is being sucked out of the vaults, loaded onto pallets, and shipped east. So, why hasn't the price in New York risen to match Shanghai? This is the critical question. In a free market, buying pressure in New York should push the price up to 94 ton. The fact that it is stuck at 76 tells us that there is an entity, a massive, deep-pocketed entity, that is artificially suppressing the New York price by selling paper contracts even as the physical metal disappears. They are holding the beach ball underwater. But the beach ball is now filled with concrete, and the water is rising. You might think this is theoretical. It is not. We have the data. Let's look at the logistics. Moving silver is not like moving Bitcoin. It is heavy. A standard good delivery bar weighs about 70 pounds, approx 31 kilo. To move $100 million worth of silver at current prices, you are moving roughly 40 metric tons of metal. You cannot put that in a FedEx envelope. You need heavy-lift cargo aircraft. My team has been analyzing flight data from JFK, New York, and LAX, Los Angeles, bound for PVG, Shanghai Pudong, and SCX, Shenzhen. Normally, these flights carry electronics, textiles, or general cargo. But starting 3 weeks ago, the manifests began showing a massive spike in Class 71 cargo, non-ferrous metals. On Saturday alone, Flight CK212, a China Cargo Airlines Boeing 777 freighter, departed JFK with a payload heavily weighted toward high-density secure cargo. We are seeing similar patterns from London Heathrow. What does this mean? It means the drain is physical. It means the COMEX registered inventory, the silver that is actually available for delivery, is plummeting. Let's look at the COMEX vault data. On Friday, February 6th, COMEX reported 278 million ounces. But you have to read the fine print. There are 2 categories in the vault: eligible and registered. Eligible: metal that is stored in the vault but is owned by private individuals. It is not for sale unless the owner decides to sell it. Registered: metal that has a warrant attached and is available to settle a futures contract. The registered category is the heartbeat of the market, and it is flatlining. We have seen a drawdown of over 30 million ounces in a single weekend. At this burn rate, the registered vaults will be effectively empty in 18 days. When that number hits zero, or practically zero, the game ends. You cannot short sell what does not exist. You cannot manipulate the price of nothing. Why is China doing this? Why now? The mainstream media, if they cover silver at all, treats it as a poor man's gold or a speculative rock. They fail to understand that silver is the strategic oil of the 21st century. China isn't buying silver to make jewelry. They aren't buying it to make coins. They are buying it because without silver, their economy stops. Silver is the most conductive metal on Earth. It is essential for photovoltaic cells, solar panels. China is installing solar capacity at a rate that dwarfs the rest of the world combined. Each panel uses silver paste. Electric vehicles, EVs. A Tesla or BYD electric car uses up to 3 times more silver than a gas car. 5G and electronics. Every 5G tower, every smartphone, every guidance chip in a hypersonic missile requires silver. China knows that global silver mining production is stagnant. We mine about 800 to 900 million ounces a year. That number hasn't grown significantly in a decade. But demand is exploding. We are entering a structural deficit. For the last 3 years, the world has consumed more silver than it has mined. We have been filling that gap by eating into above-ground stockpiles. China has done the math. They know the stockpiles are running low. They see the Western central banks suppressing the price to hide inflation. And they have decided to exploit the stupidity of the West. By keeping the price artificially low, 76 yuan, through paper manipulation, Western banks have essentially subsidized China's industrial dominance. We are selling them the strategic assets they need to dominate the next century, and we are selling it to them at a discount. It is the greatest strategic blunder since the sale of the Roman Empire's gold reserves. China is taking the physical, leaving us with the paper. And when the music stops, paper cannot conduct electricity. Paper cannot build a solar panel. To truly protect yourself, you must understand the weapon used against you, the futures market. The COMEX was originally designed to help farmers and miners hedge their risk. If you were a silver miner, you could sell a contract today to lock in a price for delivery next month. It was a useful tool. But over the last 40 years, It has mutated into a casino where the house cheats. The primary mechanism of manipulation is the spoof. This typically happens between 2 a.m. and 4 a.m. New York time. Liquidity is low. Most US traders are asleep. Suddenly, a massive sell order appears on the books. Thousands of contracts representing millions of ounces of silver. This order is not intended to be filled. It is intended to scare the market. The algorithms see the sell wall, panic, and dump their positions. The price crashes. Then, the manipulator cancels their sell order and buys back their position at the lower price. But the deeper fraud is fractional reserve bullion banking. Just like your bank lends out 90% of your deposits, bullion banks sell silver they don't have. They rely on the fact that 99% of traders don't want the heavy bars. They just want cash settlement. But here is the catch. This system only works as long as the arbitrage gap is small. As long as the price in Shanghai is close to New York, nobody bothers to fly the metal across the ocean. But at an $18 spread, the incentives flip. Now, everyone wants the metal. The longs, buyers, are standing for delivery. The shorts, banks, are scrambling. They are leasing silver from London. They are borrowing from ETFs. They are robbing Peter to pay Paul. But they are running out of Peters. If you think the government or the exchange will save you, let me take you back to 1980. The Hunt brothers, 2 Texas oil tycoons, realized the dollar was losing value. They started buying silver. They bought so much that they effectively cornered the market. The price went from $6 to nearly $50 in a matter of months. The banks were on the verge of bankruptcy. The COMEX was facing collapse. Did the regulators step in to ensure a fair market? No. They changed the rules. In the middle of the game, the COMEX board, comprised largely of people who were short silver, implemented Silver Rule 7. This rule stated that traders could no longer buy new positions. They could only sell to liquidate. Imagine playing a game of poker, winning every hand, and then the casino manager says, "New rule. You aren't allowed to bet anymore, you can only fold." The price collapsed. The Hunts were ruined. The banks were saved. We saw it again in 2021 with GameStop. When retail traders started winning, Robinhood turned off the buy button. History teaches us one lesson. When the system is threatened, the system changes the rules. This brings us to the force majeure scenario of 2026. When the vaults finally hit zero, when there is literally no silver left to deliver to China, the COMEX will not simply let the price go to infinity. They will not allow silver to trade at $500 or $1,000 because that would bankrupt the biggest banks in the world, JP Morgan, HSBC, etc. Instead, they will declare a force majeure event. They will cite irregular market conditions or logistics failures. They will suspend trading. And then, they will settle all open contracts in cash. Here is the nightmare scenario. Physical silver is trading on the street for $200 an ounce. But the COMEX has suspended trading at the last official price of $76. They force you to accept a cash payout of $76 for a contract that should be worth $200. You get your dollars back, but those dollars are now worthless, and you cannot buy any physical silver because there is none left. You don't lose your money. You lose your purchasing power. You get paid in a currency that is dying to settle a debt on an asset that has already left the building. We are 18 days away from the mathematical limit of the current inventory drain. But the panic could start much sooner. It could start tonight when Shanghai opens. Once the realization hits the general public that the vaults are empty, 2 things will happen instantly. The premium explosion, the price of a physical coin, an American silver eagle or a Canadian maple leaf, will detach completely from the spot price. Spot might be $80, but you won't be able to buy an ounce for less than $150. The inventory freeze. Online bullion dealers will slap out-of-stock signs on everything. Local coin shops will be picked clean. We are already seeing the early signs. I challenged you earlier to go to your local dealer. If you did, you likely found that premiums are rising. Dealers are holding back inventory. They know what is coming. The west to east transfer is the endgame of a 40-year experiment in paper money. We printed trillions. We suppressed real assets. And now, the rest of the world is calling our bluff. China, India, Russia, the BRICS nations. They are taking the gold and silver. They are leaving us with the debt. So, what do? The window of opportunity is closing, but it is not shut yet. You have a choice to make tonight. Option 1. Do nothing. Trust the Federal Reserve. Trust CNBC. Trust that the paper price is real. If you do this, you risk waking up one morning to find that your savings have been devalued by 50% overnight, and the assets you wanted to buy are unobtainable. Option 2. Become your own central bank. This means taking possession of physical assets, not SLV, the ETF. Not a futures contract, not a mining stock. Though those have leverage, they also carry execution risk. I am talking about metal in your hand, metal in a safe that you control. If you hold paper silver, SLV, sell it. Use the proceeds to buy physical. If you have cash sitting in a savings account earning 0.1%, while real inflation is 10%, convert a portion of it into real money. The specifics. Focus on liquidity. Buy 1-ounce government-minted coins, Eagles, Maples, Britannias. They are the most recognized and easiest to sell in a crisis. Avoid numismatics. Do not buy rare or collectible coins with high markups. You want the metal, not the history. Watch the ratio. The gold to silver ratio is currently historically high. This suggests silver is undervalued relative to gold. The arbitrage gap confirms this. The arbitrage gap of 18 is nature's way of telling you that the price is wrong. The market is screaming at you. The flight manifests are screaming at you. When Shanghai opens tonight, the drain will accelerate. The vampires are feeding. The vault doors are creaking shut. This is ESA Financial Guru reporting from the edge of the financial abyss. The data is clear. The math doesn't lie. The greatest wealth transfer in history is happening. Are you going to be the one transferring the wealth or the one receiving it? Subscribe to the channel. Turn on the notifications, because when the force majeure declaration hits the newswire, I will be live. But by then, it will likely be too late. Good luck, and get your silver out of the system while you still can.